Carvana, CVNA, has been illustrating a vivid transition from a fast-growing company to a distressed company in a year and gives us a great chance to examine the characteristics that make a fast-growing company sustainable and those that don't. Let's start with the interesting story of Carvana brought to the boring and mature used car market. Later on, we will then study it from the financial perspective and finally see if it justifies itself as a turnaround candidate. Carvana is a leading e-commerce platform that specializes in the sale of used cars. The company was founded in 2012 and began operations in 2013. Carvana's business model is unique, as it allows customers to browse and purchase used cars online, and then pick up their vehicles from one of the company's car vending machines or have them delivered directly to their homes. This approach is designed to make buying a car as easy and convenient as possible and has helped the company to stand out in the crowded used car market. One of Carvana's most notable innovations is its car vending machine. These are large, 8-story glass buildings that house cars and allow customers to browse and select their vehicles in person. Once a purchase is made, the car is brought down to the ground level and the customer can take delivery of their new vehicle. This concept has been well received by consumers, as it offers a unique and exciting buying experience, and has helped to build brand recognition for the company. Carvana experienced dramatic growth in the years leading up to 2022, as its innovative business model and unique approach to selling used cars resonated with consumers. The company's revenue increased from $260 million in 2015 to over $12.8 billion in 2021, and it expanded its operations to cover over 300 markets in the United States. However, in 2022, Carvana began to experience significant challenges in its business. These challenges were due in part to macroeconomic factors, such as the COVID-19 pandemic and supply chain disruptions, which caused a shortage of new and used cars. Additionally, the used car market became increasingly competitive, with more traditional dealerships and other e-commerce platforms entering the space. These factors, combined with operational challenges in Carvana's supply chain and logistics, led to a decline in the company's financial performance. The company has experienced rapid revenue growth since its inception in 2012. Let's first dive into a detailed analysis of Carvana's revenue growth from 2015 to 2022. In 2015, Carvana had a revenue of $130 million. The company's revenue grew by more than 150% to $336 million in 2016. This growth was driven by an increase in the number of vehicles sold and expansion into new markets. In 2017, Carvana's revenue doubled to $859 million. This significant growth was due to the company's continued expansion into new markets, increased marketing efforts, and improvements to its e-commerce platform. In 2018, the company's revenue further increased to $1.96 billion, representing a 128% growth. This growth was driven by an increase in the number of vehicles sold and higher average selling prices. In 2019, Carvana's revenue grew to $3.94 billion, representing a growth rate of 101%. This growth was driven by the continued expansion into new markets, marketing efforts, and improvements to the company's e-commerce platform. In 2020, the COVID-19 pandemic had a positive impact on Carvana's revenue growth as consumers shifted to online car buying due to social distancing measures. As a result, the company's revenue grew by 42% to reach $5.58 billion. In the first quarter of 2021, Carvana's revenue grew by 104% to reach $2.25 billion. The growth was driven by higher average selling prices and an increase in the number of vehicles sold. The company continued to expand into new markets, including Canada, which contributed to revenue growth. In the second quarter of 2021, Carvana's revenue grew by 101% to $3.34 billion. The growth was driven by a significant increase in the number of vehicles sold, higher average selling prices, and strong demand for the company's e-commerce platform. Despite the annualized 100% growth rate, the potential pressure had been gradually and constantly reinforced by its negative free cash flows or even the negative operating cash flows. The chart pretty much explains itself. Take a close look at the gray-green bars tipping south, which show the free cash flow margin and reveal the company's free cash flow has never been positive and never showed a trend of improvement. This could be a sign that the company is investing heavily in growth initiatives, but it also puts pressure on the company's cash reserves and financial flexibility. What's the lesson learned here? When you are investing in a company with a gigantic growth rate and dream of a 10-20, or even 50 bagger, make sure it is heading to positive free cash flow, at least the very first step, positive operating cash flow. Or you should be always praying that there won't be any headwind up ahead for the company. Another problem with the secular negative free cash flow is that continuous financing needs keep stock prices deviating from the market cap, demonstrated by the distance between the black and the gray lines. So what happened in 2022? According to Ernie Garcia, the CEO, the company was positioned for growth at the start of the year, but the pandemic and rising interest rates affected the affordability of used cars and led to a shift in priorities from growth to profitability. As a result, the company experienced lower volumes than anticipated and had to carry excess costs. The headwind is not obviously cushioned by any free cash flows and led the stock price well underwater of its IPOs. The opposite example of a company being cushioned by a positive free cash flow when encountering a headwind is illustrated by another chart here. This chart is Shop or Shopify. When it was riding the tailwind, it was almost mirroring the path of Carvana in good time. High growing revenue, skyrocketing stock price, negative free cash flow, and high-pitched price-to-sales ratio by the flood of Fed. Nevertheless, Shop evolved to the second stage of a high-growing company in 2021, positive free cash flow, which has obviously helped the company survive the headwind in 2022. You could see the distinct performance of the stock prices of the two companies in 2022. The bear market only brought Shop back to its secular growing path by suppressing the P/S ratio, but the company still has a bright outlook as a fast grower. On the contrary, Carvana is now struggling for its survival. So, what's next for Carvana? According to the categorization of public companies by Peter Lynch, Carvana definitely was a fast grower before 2022, and with a dramatic deterioration of its business, it has for sure lost its title. The question right now is if it could be justified as a turnaround. Turnarounds by Peter Lynch's definition are companies that have experienced difficulties or setbacks but are taking steps to improve their operations and financial performance. They may offer significant potential for capital appreciation if their turnaround efforts are successful. How could Carvana be a turnaround? Well, in response to the current headwind and challenges, Carvana's management team does have developed a plan to turn the company around. The company has outlined a 3-step plan to achieve positive free cash flow and return to growth. The first step is to reach break-even adjusted EBITDA, which they are well on their way to achieving. The second step is to achieve significant positive unit economics, and the third step is to return to growth. The company plans to reduce SG&A expenses by $100 million over the next 2 quarters and stabilize its weekly retail unit sales volume. They also expect a substantial reduction in inventory size, which they believe will lead to significant gains in retail GPU. The company has already made significant progress in improving operational metrics, including a 25% decrease in average delivery time in logistics and a 40% decrease in phone time per sale in customer care. While there may be some one-time items and extrapolations needed to fully understand the progress, the company believes that the combination of these 3 factors will lead to significantly improved adjusted EBITDA profitability over the next 2 quarters. We can tell from the narratives of the management that the plan seems solid, but definitely the focus of management is shifting from fast growth to profitability, which makes sense for a turnaround company. Besides, the price-to-sales ratio has dropped to just a little above 0, which means the stock is just valued as a call option without expiry, and the outlook of the investment in this company is largely dominated by the solvency, and the potential rate of return would be huge if the company makes it at last. In a nutshell, while it is difficult to predict the future of any company, Carvana's management team has demonstrated a clear commitment to driving growth and improving profitability. The company's strong brand, innovative business model, and focus on customer experience give it a competitive advantage in the used car market. However, the company also faces significant challenges, including increased competition and changing consumer preferences. The best strategy for investing in this company is taking the stock as a call option and inspecting the profile of rate of return and risks accordingly.